Welcome to the Lively U Virtual Learning Academy program. On behalf of the Wood County Committee on Aging, we present Chad Plontz here with us today to present his presentation on where does the market go from here. Please welcome Chad from Edward Jones.
All right, Danielle, thank you very much. And once again, appreciate everybody that's jumping on to join us here today. Once again, my name is Chad Plontz with Edward Jones here in Bowling Green. We're located at 519 West Wooster Street, just around the corner from the new senior center. So hopefully we'll be getting in-person meetings here. I believe that is the idea starting next month. So thumbs up to that, absolutely. But today we'll be once again via Zoom here going over where does the market go from here. So we'll touch on a little bit about what what we have seen going on in the markets, and then what we believe the rest of the year is going to entail. So we'll touch on some of those things, but then also we'll just talk a little bit more about our process here with Edward Jones and what we believe is a good strategy for folks. And that really comes down to, understanding where you are today and what your goals are for the future. Ultimately, that is going to help you stay on track and make the adjustments that are necessary for your specific goals to be able to be reached. So, but once again, thank you very much for jumping on. So hopefully you're seeing my screen here today, and it's like we had mentioned, where does the market go from here? So, last year's recession really reset the economic clock. We think we're really in the early stages of an extended expansion that will speed up in the second half of 2021 here, and then climb at a moderate pace in the coming years. So, if we look back at 2020 recession, which was the shortest but most severe on record, the stock market actually fell by 34% in just over 20 trading days last year. The initial recovery was also just as swift, with stocks having recouped their losses on the way to new record highs by the end of last year. This actually marked the fastest 30% plus market drop and recover on record. The good news is the recovery doesn't mark an exhaustion for for stocks. Looking at bear markets since World War II, once the market returned to previous highs, it had actually gained on average 14.3% over the following 12 months. So there is the hope for additional growth and economic expansion here. So, where are we today? If we look at the S&P 500, the S&P is actually up roughly 11% year to date. So with that being the case, things have looked good over, like I said, last year's market volatility that we saw, the recession that we saw, and then the quick bounce back. So as of late, though, the stock market has been trading, kind of treading water lately, right? Finishing last week nearly flat, and that it's been really flat, since April. So modest amounts of fluctuations happening during that time. Last week, actually, the latest Federal Reserve meeting was squarely in the spotlight, and as investors analyze the central bank's commentary and its updated expectations for future shifts in monetary, policy and stimulus. This meeting was particularly noteworthy since it came on the heels of the most recent inflation reading, which actually showed that core consumer prices are rising at their fastest clip in 20 plus years. So the Fed raised its inflation expectations and actually revealed a slightly being the main, the key word there, more hawkish tilt towards 2023 rate hikes. So we'll keep that in mind. So, I think right now we're kind of thinking the market is catching its breath. It's not running out of energy per se. It's, if you only skim the headlines this, the past week, because the last week the market was down. So if you were just skimming the headlines, you were likely left with that sense that the market has hit a rough patch, triggered by a shift in the Fed's policy outlook. Stocks did post a losing week, as I had mentioned, but it appears investors' definition of volatility and pullbacks have been kind of distorted by some of the tranquility and even keel that we've seen in the past few months. So for starters, coming into the week, it had been a month since the S&P saw a 1% daily move, with the last 1% down day coming in early May. So that's quite remarkable. Over the last 2 months, nearly 40% of all of the trading days have seen the stock market move by less than 1/5% in either direction, reflecting a very calm environment. So market volatility picked up a bit, and with the basically in reaction of what the Fed announcement was, and we expect market swings to pick up as we advance. Higher volatility should be viewed as more of a norm, though, and not the exception. Moreover, it should not be lost that the market is down less than 2% from its all-time high. We haven't experienced a 5% pullback in nearly 8 months. For perspective, the market has historically averaged 3 5% dips per year. The market has actually moved by less than 0.5% in June, and that's the second consecutive monthly move under 1%. The last time the market had back-to-back sub 1% monthly swings was actually early in 2017. And over the following 12 months, volatility picked up in that time with an average monthly swing of more than 2%. But the total return over that period was still a solid 12.8%. So beginning in late March of 2020, equities spent a year pricing in the expectations for the rebound in the economic activity and corporate profits. So the result was one of the most prolific rallies on record. The S&P rising 75% in 12 months. Those expectations are now a reality, right? As the economy is growing at the fastest rate in the post-war era, and corporate earnings are poised to increase by more than 30% this year. To that end, this recent period of consolidation to us is indicative of a market growing into its optimistic valuations, right? We don't think this means further upside is exhausted, but with the tailwinds of a strong with the tailwinds of a strong economy producing the self-restraining factors of inflation and less Fed stimulus, we think investors should expect more moderate returns, and possibly bumpier times ahead. So what I like to show here on the screen is a slide that you're seeing now, and this kind of talks about diversification and sectors of the market, right? Because we may be looking at rougher times ahead. This is an interesting slide that just kind of shows you how interesting this year has been in comparison to what maybe viewed as more of the norm. So what you're seeing here in this slide is equities. So it gives us, when we talk about equities, there's different sectors of the market. There's large cap, mid cap, and small cap equities. Now, in this scenario, when we're talking large cap, mid cap equities, so if you're seeing on the slide, the left-hand corner, you're seeing large cap value, large cap blend, and large cap growth. Well, if we look at the 10-year, so that upper left box, those boxes in the upper left-hand corner, they're talking about large cap, mid cap, and small cap value, blend, and growth, different sectors of the market there. A 10-year annualized return, you can see that growth historically has outperformed blend, and blend has outperformed value. But if you look at the year to date, so the columns on the right-hand side of this screen, you're seeing that year to date, it's kind of backwards, right? Value has outperformed year to date blend, and even blend has outperformed growth, right? So this talks about diversification and really coming back to, okay, well, where are we today in terms of our personal finances, and what are our goals, right? Because then if you have those answers, right? You know where you're at today and you know what your goals are, what you're trying to achieve. That allows you to remain diversified, not chasing return, right? So this year, a lot of folks, over the years may have been chasing returns, right? The market's doing so well, and maybe your portfolio was heavily weighted in growth to, chase those returns. Well, if you were somebody that was heavily weighted in large cap growth stocks or equities, you may have been doing well over the years, but you may be noticing that maybe your performance hasn't been as good as you would have expected this year, right? So that's just a scenario of diversification and making sure that you're not overly concentrated in one sector of the market. So I thought that was interesting information to share with everybody today. And if you're not sure where you're at in terms of diversification, or if you're over concentrated in one area, that's where I myself help my clients on a daily basis to better understand those things and how they're working with their strategy. So the next slide that I would like to show you here is actually talking about, okay, well, if we look back to last year, we had mentioned that the market had dropped 34% in a 20-day trading period. So diversification. So what this slide is actually showing you at the top of the screen here is a illustration showing you 3 different types of portfolios. So if you can see this, I'll zoom it in a little bit, you'll notice that there's a dark blue line, which on the right-hand side here indicates that dark blue line was for a portfolio that was made up of 40% stocks and 60% bonds. So the light blue line is made up of 60% stocks and 20% bonds. And the, let's call it green line here, is just 100% equities or stocks. It's the S&P 500, okay? So this kind of gives you an idea of, okay, during the pullback that we saw last year, the stock market or the S&P 500 was at its market high on February 19th of 2020. Well, if you were in 100% stocks or the S&P 500, you can see that by March 23rd, we were at our low point. So if you had $100,000 invested, your 100,000 would have been down to, less than 70,000 by March 23rd, right? So a matter of 4 weeks, you were down more than 30%, 34%. The light blue, the 60% stocks, you can see, they were down, but not as much. And even more so if you had 40% of your money in stocks, the dark blue line. So how long did it take to actually get back to our 100,000? If we started 100,000 on February 19th, well, if you were 40% stocks, it would have taken to June 8th to get back to your 100,000. If you were in 60% stocks, it would have taken to July 20th. And if you were just tracking the S&P 500, it would have taken to August 10th to get back to where you were. Now, once again, we had mentioned the idea that we went, this was the fastest and most severe pullback we've seen, on record. So this all happened very quickly. Now, if I had shown you this illustration for 2008 and 2009, when we experienced the financial crisis, it wouldn't have all happened so quickly. The stock market back then dropped over 50%, but it also took 18 months to drop that much. And if you were, tracking the S&P, it may have taken you 3 years to get back to your original value. So once again, this is just kind of an illustration that shows, how quickly this all happened and how quick the recovery followed. And then by the, year to date, in terms of performance on the right-hand side here, how the market continued to grow if you had stayed invested. And this just kind of gives you a 20-year annualized returns based on asset classes here at the bottom. So interesting whether or not it's real estate, investment trusts, emerging market equities, small cap, high yield, the S&P 500, right, kind of in the middle there, a 60-40 portfolio, how it would have returned over the last 20 years, a 40-60 portfolio, 40% in equities, and so on, right? So kind of gives you an idea just about diversification versus one particular sector of the market. So good information there as well. And once again, at the end here, we can definitely touch on this a little bit more in detail. Today, we're going to be just talking about this briefly, but if there's questions, we can definitely go over this. So another interesting slide to look at, and it really has to do with picking a strategy and really sticking with it, right? We talked about where are we today, what are our goals for the future, and understanding we can't time the market. Nobody can. If they tell you they can, they're mistaken, right? The one thing we can tell you is that history has provided some information to us here, and that's what this slide is showing you, that over the last 41 years, on this slide, you're seeing all the gray numbers at the top of this slide. So this year, year to date, the stock market is up 12%. Last year, so all the gray numbers on the top of the screen, or the gray numbers even at the bottom, right? That's where the stock market had ended the year. So last year, the S&P was up 16%. In 2019, it was up 29%. In 2018, it was down 6%. The red numbers that you're seeing at the bottom here are the low points in the market. So during the year, at some point in 2020, the stock market was down 34%. In 2007, it was down 7% at one point, but it finished up 29%, right? So what this slide is saying is that despite the average entry year drops, on average, the S&P drops by 14.3% every single year. But out of those 41 years, 31 years, the market finished with a positive return. So as you can see, if you were trying to time the market and said, oh man, I'm jumping out of the market's down 30%, I'm worried that I'm going to lose all my money, right? I've given up on the idea of sticking with my strategy. If you jumped out of the market at down 34% and never got back in to take advantage of the recovery that followed, and in this past year, it happened so quickly, you would have not only locked in your 34% loss or whatever it was when you got out, but you would have lost that much plus the 16% increase in return, right? So that could have a dramatic impact on performance, obviously for the year, but that locks in some major losses long term as well. So once again, some additional really good information. At the end of the day, I guess to reiterate, Edward Jones really does believe that we are set to still see positive returns for the rest of the year. We do believe that there are going to be, some hiccups along the way. We are, as we had kind of seen, volatility should be considered kind of the norm. I think we've seen more steady times as of late. We haven't seen a lot of volatility or fluctuations in the market. So keep that in mind that, when we do see pullbacks, and on average, a 5% drop in the market happens 3 times a year. The market has a correction, a 10% correction on average once a year. So, right, I think we're kind of due for that. The idea is let's not overreact to the short-term things that are fairly normal in terms of market cycles, but let's stick to a long-term strategy. And if that's not something that you're having a conversation with somebody about, I'd be happy to have that conversation with anyone on today. So once again, I know this was a quick rundown of, where are we today? What are we expecting with the markets? So I will throw this back to Danielle. The idea is hopefully next month, we're going to be getting together in person, discussing some stocks, stock strategies, what to look for in stocks. And we're actually going to be in person. So hopefully we'll be able to get to see some folks, and we're going to be actually having a live stock hypothetical stock purchasing option, which is going to allow you to have a hypothetical $10,000 that you can go and pick some individual stocks with, that we're going to kind of track throughout the year to see how well you can do picking individual stocks. So hopefully we'll have some folks show up for that next month. So keep an eye out for that. But Danielle, I'll throw this back to you at this point and see if we have any questions.
Perfect. Thank you, Chad. I'm just going to allow people to unmute before we stop our recording today and open it up for any questions. Any questions, anyone? No? Okay. I'm going to go ahead and stop our recording today and thank Chad from Edward Jones for hosting today and sharing information on where does the market go